Top of the morning. Almost ready. I'll get my tie on. It's a new tie. All right, today's short video is on risk. The challenge is for each of you to determine your level of risk. And I'll show you what some of the standard definitions are. But before we get into that, a quick disclaimer. Reminding everybody this is for educational and entertainment purposes only. And with that, let's get into it. Before you consider your portfolio, first need to get comfortable with your own tolerance for risk and then set your portfolio to match that tolerance for risk. And what we're going to do is put a number to it. To do this, we're going to use the efficient frontier. We've got risk at the bottom. Returns are over here. The possible portfolios are here. Impossible portfolios are here. You cannot make a high return with no risk. We want to figure out where you fit into this curve. Where are your portfolios? Are you down here? Are you up here? Where are you? Let's figure out where each of us is. Let's get comfortable with it, and let's put a number to it. Before we get too much into risk, let's first take a few things off the table. Anything you're going to spend money on right now in the near future, for the next 2 years, just put it in cash. Any known expenses in the next 5 years that is not coming out of your income, that is coming out of your savings. Let's put that in a super low risk portfolio, 80% type of bonds or something equivalent that's very conservative. And the rest is what we're talking about. The rest of that money, let's figure out your risk tolerance for the rest of it. And to do this, we're going to be reminded of the standard deviation of returns. And again, we are focused on this -2 sigma line here. As you think about risk, in any 1 year, what's the most that I could lose, knowing that my long-term gains will be more toward the average? But what's the most I could lose in 1 year and still be able to sleep at night? The example is to figure out where the line is, you've got to figure out your average and your standard deviation. And the -2 sigma, this line in the sand is, again, in the case of Apple, its average is 27%, standard deviation is 28. So if you do 27 minus 2 times 28, you get a -29%. So Apple, in any 1 year, it's got a 97% chance its returns will be greater than -29%. Here are the standard risk categories. We've got from ultra conservative all the way out to very aggressive speculative. And we have the expected return range of each, and we have the typical standard deviation of each. Now let's take a look at one of these. We're going to go look at moderately conservative. So if you are moderately conservative, it means you expect a return between 5 and 7% with a standard deviation of 6 to 10%. And you're going to be invested in a balanced stock bonds portfolio. Now I want to put in that -2 sigma line. So moderately conservative puts you down at -2 sigma from -7 to -13. That is, in any 1 year, there is a chance that you're going to lose from 7 to 13%. In the long run, you're going to be making this 5 to 7%, but in the short term, there can be a down year. And we want to focus on the worst of this as we consider risk. So let's focus on this column. So if you're conservative, that means you're down at -10%. If you're aggressive, you're going to be able to tolerate -32%. Let's go look at a standard efficient frontier. Here's one that I pulled. I used these guys, which is a mix of stocks, bonds, and then to scoot the line over a little bit, I added some consumer staples, some high dividend stocks, and some biotech products. This BBP, this thing does push the line over a bit. So if you're moderately conservative, the standard definitions are going to put you an investment in this box. So we can see right away there is the opportunity to scoot toward the efficient frontier. And that's the whole thing about portfolio management. As we set these up, we want to scoot closer to that efficient frontier. We want to keep an eye on the frontier, and we want to make sure we're getting closer to it. And you can see, as a moderately conservative, for the exact same amount of risk, you can go from 7 all the way up to 11% on the back end. And on the bottom end, the more conservative side, you could go all the way up to 7.5%. You don't have to settle for 5. So let's figure out how to scoot you over. But first, let's set this back line. This is the worst we want to see. As we look to scoot this line over, we can see if we mix, for example, this portfolio of the NASDAQ 100, nearly 70% bonds with a little bit of the consumer staples and a very little bit of the biotech. It's going to push you at 6% is your standard deviation. 7% is your expected return. So this is actually better than this -7. So 7 minus 2 times 6 is going to be -5. So this is a lower risk than the standard definition with a higher return. Now you can scoot up the line too on the high side, on the top side of the standard deviation. So we're at a standard deviation of 9 here, expected return of 10. So 10 minus 2 times 9, that's going to give you a -8. For your -2 sigma is going to be -8. So a significantly higher return with the same risk. And then if we want to get a little more diversified, go look at that video to be diversified sectors, stocks, number, percent, all that. We can get a little off the line, mix in a little S&P 500, and we can see we are still doing much better return at a lower risk than this category would imply. All right, so there are some standard tools out there you can use to figure out where you've been in the past. So in Schwab, for example, if you click on Schwab, go to Portfolio Performance, Mortgage Account, Risk versus Return, it'll pull up a chart like this, and you are here. And then Schwab puts this efficient frontier right here up higher than I think it should be for the time frame of interest. It down here close to the S&P 500. So I want you to ignore this return column and let's just look at the risk. So in this case, this puts our standard deviation, our risk percentage, at 14.57. So if we go back to this chart, 14.57 puts me squarely in the, well, moderately aggressive to aggressive category. So this 14.57 puts my historical trading in that example. I would be considered moderately aggressive or aggressive. That S&P is a good example because it's going to have a long-term return of around 11%, which is squarely in this 7 to 12%. So this 14.57 is a good number in this case. You can do the same thing at Fidelity. Go into Portfolio, Performance, select an account. You got to click on 5 years, and then up will pop this chart. The number you're looking for is right here, standard deviation, and then you can see their version of the efficient frontier here. You are actually right here, and you can draw a line to come up with an efficient frontier. In this case, in this example, this would be a good one of saying, okay, well, here's where I've been trading, and there's a lot of opportunity for me to reduce risk and also increase return at the same risk. So this is a huge amount of risk, and I am giving up a lot of money in this account. In this example, I can be much more efficient. So the challenge for everybody is to go set a target risk for yourself. Go figure out a standard deviation. Look at what you've done in the past. Think about what your tolerance is. Think about how you sleep at night. And let's figure out where you fall in this chart, come up with that standard deviation number that fits you. And with that, we can come up with a better portfolio with lower risk that meets your long-term investment needs. And with that, let's take another peek at the lizard, and we will bid everybody adieu. All right, gonna retire another tie. Kaboom!